Hey YouTube, welcome to OMFG, On My Financial Goals, the YouTube channel where we go over Canadian personal finance videos for you millennials. I'm Imtiaz.
And I'm Raymond. Now that we've covered mutual funds in our last video, we will explore the alternative and more cost-effective way of investing using exchange-traded funds, ETFs for short. As we've explained in the last video, the ETF is similar to the mutual fund in the way it holds bonds and equities, but it is traded exactly like a stock.
Stay tuned and we'll go over in more detail of their fees, how to buy ETFs, and why we think it's better.
Let's dive straight into the management expense ratios of the ETF. This is the most advanced way of getting into the Canadian cash potato method, but it also saves you in the long run.
It works by giving you the lowest MER compared to a mutual fund. Going to the mutual fund way, you will have a higher base cost compared to the ETF equivalent.
For example, going with the Tangerine Mutual Fund to implement the Canadian cash potato, you will have to pay an annual MER of 1.07%, compared to the ETF equivalent, which can get you as low as 0.06%. Okay, you're probably asking, that's only a 1.01% difference. Why should I care?
Well, the reason for this is because if you had $100,000 to invest, that 1.01% would go a much longer way. Specifically, $1,010 per year. And that's only for a single year. What if you kept that investment for, let's say, something like 10 years? That's about 10K you lost plus growth potential. Do you want the bank to have all that money, or would you rather put that into your own pocket? Well, we'll let you answer that question, but we know our answer.
There are other advantages when using ETFs for your portfolio. The first example is minimum holding time, more liquidity. ETFs, just like stocks, can be bought in the morning and sold in the afternoon. Whereas mutual funds, there's usually a minimum holding of 90 days before you can sell it back to the market.
The other advantage that we'd like to point out is that you have more choices and diversification. There are much more ETFs out there that do the same thing. For example, tracking the S&P 500 with slight variances such as better tax efficiencies that can be purchased, or you can purchase them in another currency.
And the last advantage is the consolidated fund solutions. Some ETFs combine all or multiple markets in one fund. For example, the fund XAW holds both US and international indexes instead of purchasing individual funds for those two.
Now that we've gone over all the amazing advantages, there are some disadvantages to consider. One disadvantage we want to mention is that you do need to go through a brokerage to purchase ETFs. The big 5 banks offer their own brokerages. For example, TD has Direct Investing and RBC has their own investors platform. And while they do offer this, they are a little bit more work to open and work with compared to opening a mutual fund. There are also independent and online brokerages out there which have the advantage of lower fees. Some of these include Questrade, Qtrade, Visual Brokers. We recommend going through an online comparison tool that MoneySense has for all the Canadian brokerages available, which we will link below.
As you know, we like being cost effective when making decisions in our everyday lives. This is why we both like the do-it-yourself investing, as it is the most cost-effective method to implement the Canadian couch potato portfolio.
We both recently switched our portfolios into ETFs from mutual funds because we recently discovered Questrade. We want to emphasize though that we are not paid by Questrade in any way, shape, or form, but we do believe it's a great platform for us to invest in.
The main advantage that Questrade gives compared to other brokerages is that they offer virtually free purchasing on all ETFs. Yes, free! Well, technically they do charge a fee, but it's so small it's quite negligible.
This allows us to constantly be able to contribute to our funds no matter how small the contribution. Do keep in mind that there is still a fee to sell ETFs, with a standard commission rate of up to $9.95.
You're probably wondering why we put brokerages as a disadvantage. The reason why is it's not as simple as buying, selling, and opening a mutual fund account, and depending on how much you're starting out with, it may also not be free. It also has a higher upfront cost to open an account with a brokerage. As an example, with Questrade, you need a minimum of $1,000 to start an account, and a minimum of $5,000 to prevent being charged a quarterly cost of $24.95 for an activity. There are also small things to consider, like the cost of buying and selling ETFs, transfer fees, and also the ability of not being able to buy partial units like mutual funds. In general, ETFs are the most cost-effective way of doing a do-it-yourself portfolio. But if you're just starting out and trying to get your feet wet in the world of investing, Mutual funds like the ones offered by Tangerine or the TDE series are still the best way to go. If you're curious, we both started with the TDE series mutual funds. We hope this clarified the ETF for you and why we like to use them when implementing the Canadian couch potato portfolio.
Do you currently invest in ETFs? Which ones are your picks? Let us know in the comments below and we'll get back to you.
If you liked our video, please like and subscribe, and don't forget to follow us in our social media channels. We do weekly personal finance videos just like this every week.